From what I found, you ultimately raised $25 million for Arcus, correct?
We've raised a little over $50 million to date in equity capital for the business.
As a solo founder, raising more than $28 million, how did you do that?
We raised $100 million total at CleverSafe, sold it for $1.4 billion.
From what I found, you ultimately raised $25 million for Arcus, correct?
Correct.
Walk us through that journey. Like you're building this product, and give people context as to what the product ultimately was, servicing the Latin market. But when did you decide that you needed to raise money, and what was that experience like coming out of YC?
Yeah, I think coming out of YC, the expectation to raise capital is pretty standard. I mean, everything's structured around that. So, it's a 12-week program and everything's structured towards, putting together a demo day presentation where you can show off your growth during that 12-week time frame. Went out to demo day, didn't raise much. Then after that, really changed my pitch, and I got a second opportunity to pitch at the TechCrunch Disrupt, which back then was really a big deal. It was kind of like and I got an opportunity to pitch TechCrunch Disrupt in September 2013. Made it to the finals. That went live, streamed on CNBC, and about 6 months after that, I wound up raising a total of about $3 million seed. And so which was a lot of money for back then for a seed round. And after that, I was off the races and quickly learned that nobody wanted our product. So wound up killing that version of our product and wound up raising in small chunks a number of rounds up until we got to our A in 2017.
So let's talk about that. This is often the untold story of fundraising because, in the press, because you change your name. You changed the name in 2017. So for bystanders, people that are just reading the headlines, it's like, oh, where did this company come out of nowhere and raise all this money? Like, oh, it's so easy for some people. And, that kind of, external facing lens that is not a true example of reality. So it sounded like you had multiple, pivots and iterations. Like, how did you navigate not landing, having all the expectations of YC, raise the money, not hit, with PMF and product market fit, and then kind of subsequently say, sorry, we missed that one, but give us some more money and we'll try again. What was that like?
Well, part of the great thing about YC, and I'll say this about a lot of our investors, we raised predominantly a West Coast round. So we had a lot of great folks from the West Coast, is that they expected, this is part for the course. Like most companies don't hit it out of the gate right away. In fact, again, when I'm back to YC as a partner, I think one of the other partners showed a slide that said 90% of the companies fail. 9.9% of them succeed over the course of 7 years, and 1% succeed overnight. So if you haven't succeeded yet, you're on the right track. So that gives you a little context in terms of like what the natural path is. And I think when you understand that, you feel a little bit less anxious. So I knew and believed we were on the right path. And by every single pivot, of which there were many, there were like 4 or 5, I felt like we were just getting inching closer towards success. But yeah, it was a grind. 13 to 17 was like a number of small rounds, like $1 million here, $1 million there, putting together until in 2017, we finally got a term sheet for $10 million from a major bank. And as I indicated in my book, I'm the underdog founder, that was pulled with 3 days left to sign. I had to hop on a plane, go to a conference in Phoenix, and, schmooze left and right. I was told, no. I got one maybe, but that one maybe was from a fund in Mexico. I flew to Mexico, and in 2017, we all know in Mexico, the biggest earthquake, it's on record, happened. That was the day I was flying. I flew an emergency landing into the Mexican airport, and then my meeting got canceled and they told me to go home. And I was like, I'm not going home. For what? Like we got 3 weeks of runway. Well, what am I going to go home? I will not get on a plane without a solution. So I got a week later, got to meet with the partners at that fund's office. And then by the time I got back by the time I got to the airport, they told me that they were going to do it. So I ended up raising an $8 million aid around November 2017.
So let's unpack a couple things here. So let's talk about the Mexico meeting. Was this your first time ever talking to this firm?
No. So they were part of the round already. So there was a $10 million round. It was anchored by this bank in the US, and the Mexican fund was going to be a co-lead second biggest investor. But then the big bank kind of just did what big banks do and just decided not to do it with zero reason why. And I told this bank, the fund in Mexico, give them context as to, why they pulled out, why in fact we were better off without it, and in fact that we were doing very well in an upward trajectory, and this was the last opportunity they were going to have to be part of this trajectory with us, and we felt like they would add a lot of value given a lot of the work that we were doing in Mexico. And luckily enough for us, they bought into our vision and mission, and they saw it as a strength, and they came in and invested.
As a solo founder raising more than $28 million, how did you do that? How did you bring on those early resources? What did you validate? What did you achieve to be able to lure in investors? And how did you get access to those investors?
Yeah, totally. A few different factors here. So I'll preface all of this by saying, we definitely raised our pre-seed round in the golden age of fundraising. So I also want to just be realistic. The advice I'm giving should all be taken with a grain of salt, because we raised our seed round in 2021 when it was much easier to do that. And also, frankly, when digital health world was all the rage. So that was also helping in our favor. And COVID, there were a lot of things working for us at that point. I just to answer the more tactical parts of your question, very early on, when I was first kind of toying with the ideas of Parallel, I was trying to get buy-in from investors. So anyone I knew in my social network who was an investor or new investors, I was trying to take coffee chats with those people just to start putting the idea in front of them. And I used those conversations both to develop my own idea as well as sort of pitch the idea. The trick was to go in and not act too firm on this is exactly what I want to build. What do you think of it? But more so hey, you're looking at a lot of companies in these spaces. What do you think of these ideas? Is this of interest to you? What do you think funding looks like for a company of this? What are all the longer term considerations I want to take into account? And I did that mostly because I came from finance world and my biggest fear was not being able to fund the business. Especially actually, I remember the very first thing and the catalyst for needing to go raise money was our legal bills were really high because I didn't want to mess with providing healthcare services and not having the right legal structure in place. And so I remember the first, the cost of the lawyer quota was $25,000 to set up all of the legal professional corporations and so on. And I won't get into all of that, but healthcare world is a slog. And so I was all right, we're going to have to go raise money at some point. I kind of kept kicking the can down the curb. But it made it really easy when that day came and I was ready to do it, to just call up those same people and be all right, today is the day. You've already kind of got buy-in to this. So I would say that that's how I kind of got the friends and family part of the round done and got a few early angel investors on board. And from there, utilize those connections as much as possible to get intros to the actual funds that could give us much larger check sizes. So we set out to do a $500,000 pre-seed round that pretty quickly morphed into just our seed round. When we started actually talking to institutional investors. Again, golden days of fundraising. So I don't know if this would happen today, but we're lucky enough to have 3 term sheets on the table to ultimately choose from. and ultimately went with the partner that felt like the best fit for us. But I think a lot of fundraising is just playing the game and utilizing the connections as much as possible, especially when there's a lot of momentum. So like coming out of angel investors writing checks and being super hyped about your business, getting as many intros as possible to funds, and just like keeping the ball rolling was definitely a factor in our success.
So I guess give us the history of the capital raising. So it's $2 million about, call it 8-9 years ago. What other capital did you raise, and when did you raise it?
Yep. So we've raised a little over $50 million to date in equity capital for the business. The most recent round was in April of this year, 2024. We raised a $22 million round, our Series B, led by Airbus Ventures, the venture arm of Airbus. Our Series A and our Seed and C Plus were the prior rounds. So between those three, that was $28 million of capital raise.
And, when did you get your Series A? What year?
Our Series A was 2021.
Okay.
Was 2021.
And had you started generating revenue on the commercial or governmental side of the business at that point? Got it.
Yes.
So that makes sense.
That was when I would say we started to generate, when we had initial traction across all three. Some was more meaningful than others, but at that point we had meaningful traction across government, consumer, and commercial markets.
So, appreciate you giving me some background on, kind of the fundraising history and kind of where you guys been at and the overall development of the business. But I want to be frank here. Like, a lot of our audience, they're in software, they're in consumer, they probably get the apparel brand, but to understand material science, deep tech technology, I would like to kind of gravitate towards that area of the conversation to give our audience a little bit more of insight into how these businesses work. You talk about one angle in terms of licensing the technology to a PE firm for the apparel side of the business. So you kind of remove yourself from that aspect and can do focus on other things. But when it comes to the deep side, deep tech, are you manufacturing? Do you build the actual manufacturing facilities, the machinery, the equipment, or are you more or less outsourcing the development of that stuff? It'd be curious to kind of hear like how that process developed, and also just like what you're using the amount of capital that you raised, what it's going towards.
Absolutely. We had two choices when it came to how we thought about manufacturing our technology. The two options are, do we take it in-house and do all the manufacturing ourselves, or do we go contract manufacturing? We ended up going contract manufacturing, at least today. And the reason we picked contract manufacturing was it provided immense scale very quickly, allowing us to grow the revenue of the company very quickly. Compared to if we went in-house, would have taken a lot more CapEx and a lot more time to stand up meaningful supply of the technology we had just created. That is a gross oversimplification because at the same time, what we really had to focus on in order to make our technology able to be contract manufactured very easily was a lot of process engineering around, hey, how do we actually take what was historically a pretty hard material to make and make it so that we could walk into, foam manufacturers, and without them having to invest serious CapEx into new equipment, just be able to manufacture solar core foam using our IP. So that took a lot of amount of work to make that happen. But the benefit is it created the ability to rapidly scale manufacturing of our solar core technology. So we go contract manufacturing today. Will we always go contract manufacturing? That could be a pretty heated debate. The only downside with contract manufacturing, I'd say, is the main downside is gross margin. When you bring it in-house, you gain back all those points of gross margin you give to your. That's the debate over time. between the two.
Yeah, and you get to a certain scale where certain level of revenue and profitability, and you can run the math of when it makes sense to kind of transition and bring it in-house. But it's also like it's a huge CapEx investment. It's basically what Tesla does as far, for an easy reference, like they're building everything end to end, and look how much money and time it took to do that to reach that kind of scale.
Absolutely nailed it. That is exactly the equation.
What was your fundraising experience like in the early days? When you kind of got your first initial round, kind of walk us through what your strategy was. How, was it cash right off the get-go, easy as can be, or was it a crazy journey to kind of find your fit there?
Yeah. Well, I mean, we raised our first round of institutional capital, our seed round, at the end of 21. So certainly, was a different world for a lot of people, right? In a lot of ways, it's funny. I look back at it now and I have mixed feelings, really, because I hate it because I think obviously a lot of valuations and expectations were just inflated for a lot of people, not just our company, companies throughout PropTech, fintech, the entire ecosystem, really. Probably everything was overvalued, which I think sets up companies poorly down the line, especially companies that took a lot of capital in those environments, right? We were fortunate enough to really only take one round in that, crazy environment. So there's a lot of time to sort of right size things to more, achievable valuations, let's say, as you track your company and grow it, that I didn't really understand before I came in and started understanding the fundraise game. And, you get presented with a term sheet in 2021 and your valuation's this, and you're like, that's amazing, right? Like, I'm worth this money. I did it, right? But you realize that really quickly that you got a long journey ahead of you and there's no guarantee of an exit, and you've got to prove that valuation, right? Every time you get a term sheet, you're now getting notched up a bit, and you're notched up a bit, and you're notched up a bit. And if you're not actually justifying what you're valued at on paper in private markets, like that will bite you eventually, whether it's now or 6 years from now. And I think you see that throughout the entire ecosystem, right? So I think that was the negative. I think the blessing from it, honestly, when I look back is, and a lot of people have told me this, like, wow, you had, sort of like perfect founder market fit for the idea you were going after, right? Yep. And you worked at Airbnb, you had product experience, you had strategy, operations work before that, you had finance work before that. Like that's literally what it takes to get something like this off the ground. Of course, like, VCs are going to be interested in talking to someone like you. And that was correct. But I tell people all the time, had I tried to start this business this year, I don't know if I could have even done it, because I think there is an initial quantum of capital that it takes to get something like this off the ground. And that unfortunately is just not here without some type of traction or evidence in like 2022, 2023, and I think even 2024. So I think I needed the initial environment to get that injection, but then, I'm glad it was able to get into where we are today, I think, because it's a more healthy environment, provided you can fundraise.
Yeah. And I think that's very insightful for your, being able to reflect and acknowledge that, because I think that is true for a lot of different businesses, but you were smart enough to realize it and pace yourself accordingly. Where I feel like a lot of other companies took that money and lit it on fire as fast as they could, thinking there was going to be twice as much a few months later.
It's tough, though. I have a lot of sympathy for some of those founders. I do. I think especially the first-time ones, right? And I can empathize with this, being a first-time founder myself. You think that, I think it's a journey for a lot of founders to have high conviction and high confidence. And I think a lot of founders don't want to admit it, but most people have, and most people in any walk of life, when they're doing something new, they're stepping into a new role, there's a bit of imposter syndrome. You're running a company. All of a sudden you're the CEO of a company and you've got some money, but you've got a big name investor telling you to do X, Y, and Z, or you've got, Sequoia's not on my cap table, so I'll just throw the name out, but they're big name, like Sequoia's telling you to do whatever, or SoftBank's telling you to do whatever, right? Like you're saying to yourself, wow, that's so-and-so, or these people know what they're talking about. And, not to say that they don't know what they're talking about, but they have different objectives than you, right? And I think you realize that as you grow as a founder, as you grow as a CEO, their objectives are different, and doesn't mean they're wrong or bad, but you have to understand that. You have to understand why they're telling you to spend the money, what they want out of that, and what their end result that they want for your company is versus what you might want for your own company. So I think it was very easy for a lot of folks to just get that money, and sometimes even on strings attached of like, you have to go spend it. So yeah, I feel fortunate that none of that happened with me, but I have a lot of empathy. I think it gets kind of blown up in the media, like founder X pulled in all this money and blew it yesterday. I'm like, there's a lot of people around the table that condoned that blowing of $100 million. It wasn't just that person. Sure, it was ultimately their call, but like, you don't know what was going on in the boardroom or behind the scenes with some of this stuff.
That's a good way to put it. It wasn't like it was a runaway founder that had no oversight of any kind.
There might be a couple of those stories out there that we've heard the last few years, but I don't want to judge everyone off of that. Let's put it that way. But yeah, there's someone you're scratching your heads. I won't name names. And you're like, oh, did they have any diligence on that? What was going on there?
The answer is you leverage the timing. You get a sizable seed round, $11 million. Massive. But you come out, I guess, when did you close your Series A?
We closed our Series A over the summer. So we recently announced it about a month ago, primarily because when we first closed, we were fortunate enough to close it over the summer and pick up a little bit more along the way. And recently got it out. So it closed an $18 million seed or Series A, I should say.
Yep.
This time I had co-leads involved, which is interesting, but it's certainly a different ecosystem to raise in than 2021, night and day in a lot of ways. Super fast in 2021. I think it took us, I want to say from the time we started to the time we actually have money wired, maybe 2 months, 2021. And then the Series A rolls around. And I think if a founder hasn't gone through it already, they will. And it's I tell everyone I talk to, it's a very different world out there. The biggest piece of advice I'd give to people is make sure you give yourself time. It's not impossible, but it is absolutely harder. And the tables have turned where, in 2021, there was so much capital to go around. VCs were looking for places to stuff it, right? They needed to deploy their own capital. And now it's the opposite way. They don't need to deploy anything. For anything, they're kind of safeguarding it. And they've got 10 companies they're looking at, and really only enough powder to do 2 or 3 deals. So, it's possible to get a deal done, but they're going to be very picky and choosy about who they invest in, why they're investing, and they're going to make sure that diligence takes as long as they want it to take. So give yourself the extra time.
When it comes to the fundraising and deciding that you're going to build a company that's going to take hundreds of millions to get there, what's it kind of been like raising capital in all these different market cycles that you've had experience?
Well, the toughest time to raise money for a company is always as you're finishing early stage and beginning growth stage. And sometimes a company will have the first phase will be like the research phase. And we have that at Ocient because we're like, oh, we think we can make something that's just fundamentally different. So now we're in the research phase where we need to fund that to prove that. And it's all about potential. And in some ways, potential is kind of an easy thing to fundraise on. Like, look at this giant market. Data is growing like crazy. Look at how smart these engineers are. They're going to do something amazing. That's basically the pitch. And there's a lot of investors that like that pitch. And then you get into early stage, and it's like that's where you're kind of doing everything that's important in the business 2 or 3 times just to prove you can do it. And then it's also still about potential. You're getting these initial customers, look at the results. I mean, we're transforming their business efficiency or whatever it is. And it's not a lot of revenue, but you're just proving that, we can sell into this existing giant market. So that's also about potential, relatively easy to fundraise for. Then you get into the growth stage. It's like, wow, look at this. My revenue's, 20 million, 100 million. It's growing like crazy. That's just numbers. In some ways, that's easy to fundraise for. It's that in between where you've done it a couple times, but your numbers aren't that great because you've only done it a couple times with each customer, and you don't really. You're maybe doing $1 million or $5 million or $500,000 or something like that, but you need this big pile of money because that's the time when the business most needs cash. If the market, let's say, gets really cautious in its fundraising or its funding, if you're in research phase, you just slow it down. If you're in early phase, you just slow it down and just drop the burn rate in half and then have the product come out at the other side of that canyon of non-funding. If you're in growth stage, growth costs cash. So you just slow the growth down and just kind of wait it out. But if you're in that middle phase, you have to have cash because you don't have enough margin contribution to live off that. But yet you have to have this enough investment in the product and sales and marketing to sell it because you got to grow it. You have to grow at that phase or you're dead. But that really consumes cash. So you have to have cash, but you don't really have great top line numbers. So that's the toughest time. And I think I'm the only person that I know of I may be the only person who's had to raise for 3 different companies in that phase during each of the last 3 recessions. The Silicon Valley Bank failure, and maybe that's what we'll call this recent one. The Great Recession was the one before that, and the one before that was the dot-com crash. And each time I had a company like finishing early stage, beginning growth stage, those are really hard to finance.
What was that process like? It's like, you say hard, but like, what was it actually like? Like, were you going on just like it was a million no's? Like, what was your process? And kind of, you obviously overcame and you had success.
Yeah.
So, what was your actual process in each of those cycles? And, what's something that you can share with our audience?
Well, the first thing, if you want to raise money in a time like the dot-com crash or the Great Recession or the Silicon Valley bust or whatever we're going to end up calling that one, the business has to be flawless. There can't be any fundamental flaw in the business. You have, like, everything that's important has to be going really well. So like your initial customer implementations have to be mind-blowing. The product has to be way better than competition. Your investors will call those customers, and they need to like genuinely say, wow, this is amazing. I've looked at everything else and nothing is as good as your product. And so just like go right down the list of everything important. You cannot have a flaw in the business. So part of what you have to do, you and the team, is you have to make it flawless. And you're doing it at a time when you're resource constrained because you don't have a lot of cash. You're trying to make cash last. Money's not exactly pouring in. So that's like a big part of the equation is there's no faking it. You have to make the business flawless. And that is just simply hard work on everyone's part of the company. Then in terms of the actual fundraising, you're going to, it's going to take some time. Like, if you look at me at Ocean, I was rolling out of CleverSafe, which was a very similar company. We raised $100 million total at CleverSafe, sold it for $1.4 billion. So I had a little bit of goodwill, with investors, and even then, that was not an easy fundraise to get through that phase, which we did at Ocean. But it's not like, oh my God, look at this last company, you did a unicorn, let me just write you a check, no questions asked. I know for sure that I've pitched over 300 investors for that round. The round that we just did at Ocean. And I ended up getting maybe 20 of them, 30 of them to invest. So my hit rate was about 10%, which is amazingly good for a time like that. But that's just what it takes. You've got to do all that hard work hundreds of times over of getting to investors, establishing a level of trust where they're going to, hear from you. A lot of them are going to go through diligence. It's a lot of work. There's no doubt about it.